Big news coming through, and I want to bring that to you. The first thing I want to talk about is real estate. We're going to look at the residential side. We're going to look at the debt. We're going to look at the commercial, all things surrounding it from the US to Canada to Denmark and so on. The second thing I want to cover is commodities. That connects directly into this. Of course, you're seeing lumber prices that were at $1,700 now under $500. How does that affect you? And how does that affect? In the third thing, we're going to look at the uncertainties in the market. What's going on here? A lot to cover. Let's go. Let it be known. Why are we here today? What's happening? There are two charts I will show you. The first thing, major economies, central banks, total assets, that is the blue line, and then the MSCI All Country World Index. Going back since the financial crisis up until today, I think it's pretty obvious. The central banks are creating this easy monetary policy like we've never seen before, pushing asset prices up. And of course, you could see this, the S&P 500 versus the global M2, where you have the ridiculous amount of money that's been pumped into the system. This is just showing you basically since the beginning of the year up until now. And it's the same sort of situation where more money is coming in, whether it's coming in from the governments, whether it's coming in from the central banks. You are seeing easy monetary policies, very, very low interest rates and extreme levels of central bank, sorcery, if you want to call it that, because that's kind of what it is. But you're looking at this right now being the underlying cause of everything we're seeing. If you have that in your mind, then we can move on. Let's look at this. This comes out of Canada directly from the StatsCan website. Household mortgage borrowing rises by a record amount. Does it have anything to do with the fact that interest rates are at rock bottom? You can get a mortgage for 1%. Sometimes 1.5%, and in some cases 2%. It all depends, many factors around it, but the interest rates are super low. Super low. The inventories certainly have declined in many areas, and you're looking at the sales as a result coming down because there's just isn't that availability. Plus, on top of that, you have the seasonality because during this period of time, sales are generally slow. Come September, we start to see things pick back up. But I wanted to show you this just to give you an idea of what's happening in Canada. Many people have asked, what's going on? What's going on? I've also heard from Denmark, one of my subscribers sending me information, and you're seeing the sales slowing down dramatically. But guess what? Just like in Canada, just like in the United States, the prices have risen considerably. All right. Household mortgage debt continues to climb at a significant pace, increasing 1.4% in June from the previous month. This growth represented the rise of $23 billion from May, the largest monthly increase on record. Why? Because the prices are excessive. Compared with June 2020, mortgage borrowing was up 9.2%, a pace not seen since 2008. Okay. Now, the crisis that the US experienced in 2008 was not felt in Canada. There was a slow period. House prices came down a little bit, just a little bit, but certainly they took off from there. The point here is there is a maximum for how much a person or a family, a household can borrow. If you look at areas like Denmark where you're getting 0% interest on your home, this is basically maxing out. That's it. There's only so much debt a family can take on. So what does that mean for the future? Well, of course, you get to a ceiling, and then houses can kind of ride along that for a long period of time, and that's not good. You don't want to see that. Now, if we switch gears here, this is the US, and I'm going to show you two charts, and you're going to see the 60 plus days delinquency rate. The three on the left side, let me try and split this. If you look at this right here we are seeing the retail, and then here is hotel, okay? Just to give you that idea. And we're seeing December 2019, 2020, 2021. So you could just see how the pace moves through. Hotel and even retail to a certain degree had accelerated, okay? You see that from 4% to 12%, from 2% to 20%. Wow. Now, that in itself, it's interesting, okay? But let me show you the next one before I start my rant. Look at this. Isn't this the strangest thing? This is office. 2019, same thing, 60 plus days delinquent. 2.6% office from 2019, 2020, 2021. All of them, no change. To me, extremely questionable, very questionable, and I just don't understand it. From what I have heard, from all, like, so much information coming from data I've seen, coming from anecdotal evidence, for instance, people working in construction telling me, I had somebody telling me specifically and showing me evidence, going through in Toronto, the big towers, all the financial towers, insurance companies, the banks, and so on. They were ripping out, this is 2020, ripping out the floor, getting rid of it, bringing it back to bare bones because their lease is done and they're getting out of there, and now they got to wait for a new tenant for that particular floor. Then that individual telling me he's hearing from other trades on different floors in the building that they're doing the same thing. The commercial office space being hollowed out in many of the financial sectors with no need to have more people to come in, to have more floors occupied because of the whole work from home being permanent, or let's say half the period of time. I know of companies that are basically saying, this department, that department, you are going to be working from home permanently. But this department and that department, you're going to come in as needed. So our real estate shrinking from 3 buildings down to 1 building is going to make changes. It's not just one company, but a lot of them are doing this, okay? And then last but not least, for this period here, just wanted to show you what has happened with sinking lumber prices, forcing Canadian mill to curb production. What? Think about this for a second. We had the prices rising like crazy. Oh, the lumber mills, oh, they're shutting down. Oh, we need to get more people in there. We need to hurry up with that production and get things going again. As a result, prices start rising. We all know this, right? But now the price comes down and is forcing Canadian mills to curb production. Are you telling me that they're going to artificially boost the prices? Is that what they're trying to do? Is it? Look at the price. Okay, I mean, I think it's pretty obvious. You could see it peaks out at 1670 to be quite accurate, or 1686, I guess. And ever since then, it's been a straight line downward. Currently, as I record this video, it is at 473. Anybody who shorted this, just look at that, spectacular. Where was the peak? May. From May into August, I mean, that is an incredible gain that they would have made if they held on. Now look at the price. I want to just show you this, okay? If I go back to 5-year, we are still above where we were all throughout. Like, I'm looking at 2016, except for this rise up in this period here, 2018 timeframe, okay? But just go with me for this. It's pretty much, except for whatever it is, a year, 6-month timeframe, we were much lower than that throughout this entire period. And now they're saying we got to curb production, when you were saying that the price was only like this because of the reduced production. What's going on here? A lot to think about. And I want to talk more about this in the Money GPS Insights. Real estate debt is at an all-time high globally, putting further strain on individuals and the financial system. The weakest link, as far as I'm concerned, is commercial real estate, no doubt. Quite frankly, the worst hasn't been seen, and there are going to be companies that absolutely will fail, will need to be bailed out, will need to be nationalized, but I believe it will come from the commercial side because we haven't seen the worst of it yet. I want to give you an update on what's happening here. This information comes from Bank of America, and you could see durable goods spending versus leisure services. It gives you what has been occurring over the 2-year percentage change. Leisure services by income cohort, spending on airlines, spending on US versus non-US airlines. Like, just go through it all. And what we see right now is it was leveling off and now it's dipping down as of new information. We're talking about August data right now. And I'm seeing that across the board in these charts. This is daily online retail spending, spending at lumber and building materials stores, total card spending, so on, okay? All of these things, for the most part, are declining right now, showing you, as far as I'm concerned, stimulus wears off, the economic boost goes along with it. Plain and simple. You're giving out checks to people, you're giving out stimulus checks, you're giving out the unemployment benefits. That makes its way into the spending. You take that away, and people simply don't have that extra money to spend. If you give people $500, the average person, they're going to spend the $500. That's just the way it is. And that's the whole point, right? You want people to be spending that. That's the reason why they created these stimulus packages, to get money from the taxpayer, funnel it through the system, and then people go to the store, they go to the restaurant, they go wherever they can, that's not locked down, and then they would spend that money and hopefully that boosts the economy. But you see what happens when it runs out. Immediately has an impact. So what does the future have in store? It's just funny because this is an unsustainable system that they've built. What are they going to do? What are they going to do here? All right. Looking at this Bloomberg article, it's basically talking about what's happening in the stock market today. And I found it to be interesting that they've suggested right now that there is a lot of risk and less upside, though the vast majority of these individuals, you know, your typical analysts and so on, have said that they believe the stock market will go higher. And just a quote here, we can point to a number of positives in the economy that are supportive of risk assets. At the same time, there are also plenty of issues that are too close to call, and the macro outlook could vary wildly depending on which way the coin lands. Okay, so they're essentially just saying that the stock market has gone up, it's doubled, things are looking really iffy at this time. Many reasons for that. Of course, we don't know about what's going to happen with a tax hike. We don't know about the infrastructure. Things need to get passed. Okay, so what I would say, I've said it many times before, infrastructure bill, debt ceiling, the fourth stimulus check, all these things go through. I think that's going to have a positive impact on the stock market. Okay. And then last but not least, I want to show you this. Michael Burry's pretty big short hinges on treasuries sinking. Player in the big short bought puts on iShares Treasury ETF. So we're going to see what happens with this. I had talked about this in a previous video talking about Michael Burry and what he was doing. And now Bloomberg is finally getting on that. So we'll see what happens. They're usually late to the party. You know how it is with the Money GPS, bringing out the information before the news. It's the news before it's news. If you want to be able to get the intel, if you want to know the news before it's news, the only way to do that is to be an insider, because I'm going to bring the videos to you directly. We're going to go around the censorship, around the shadow ban, around all of that nonsense. And the way to do that for free, of course, is right here at this card or at themoneygps.com. And of course, if you haven't already, hit that thumbs up button. When you do, you make a unicorn smile. If you haven't seen this video yet, you definitely want to check it out. Click it, and I'll see you there.